In this video, guys, I'm going to look at 3 indicators to measure volatility. Stay tuned. Hey traders, warm welcome to you. So measuring volatility is handy. Why? First and most useful reason to measure volatility is to be able to say, hey, I want to get into this market or I want to get out of it. Now, maybe you are the type of trader who seeks volatility. If you are, you're obviously going to want high volatility, and these will help you guide into high volatility markets. Or perhaps it's too volatile and you have a filter in place that's a protective shield to stop you getting involved in markets that are too volatile because you know that you lose money under volatile conditions. The second reason you may well want to know volatility and have a definitive value on it is for your position sizing. If the market is above a certain volatility, I know I want to reduce my position size. I don't want to have the same position size in every single market condition. Now, we're not talking about adjusting position size based on setups or strategies. That's a different tactic. But you might well say to yourself, well, actually, you know what? The volatility's increased. My stops are going to increase. And perhaps if you have a fixed stop, that's something else. Another number 3, perhaps we can call it, is if you have a fixed stop in the market. If you trade the same thing day in, day out, you're a specialist in a currency pair, an index, in a commodity, whatever it may be, you may well have a fixed stop. And that's something that a lot of traders do. They're day trading or swing trading, they have a fixed stop. If volatility then contracts or expands, they adjust the stop to suit. If it's a very, very quiet market, you don't need such a wide stop. You can drag it in. So it's very useful to get a gauge of the volatility. And also, if you're looking at trade setups on new markets that you don't normally trade, it enables you to have a rough idea of how much this thing shifts. You know, if the volatility is wide, you're like, okay, it's a bit of a swing, or I need to be a little bit more cautious, position size, etc. It's just a good overall gauge. So let's look at the 3 indicators that we can use to measure volatility. The first one, guys, is ADX, Average Directional Index. Now, generally reading above 20, 25, maybe extreme 30s is the indication of a trend, because it takes highs, a number of highs that are broken or lows that are broken. It's really a good tool to tell you if you're a trending environment. It's perhaps not as good to indicate volatility, although it can be used as such. If it's a rising ADX, it means that the trend is increasing. Now, it's not directional, so you're not going to know if it's increasing to the upside or the downside. But if the ADX is increasing and you can see the price action is increasing, you can say, hey, well, this potentially is getting more volatile now because we're getting more extreme moves, we're breaking out highs, making fresh highs, that kind of stuff. So it's a reasonably good gauge. I think out of the 3, which we're going to talk about the 2 in a second, it's probably the least favorite. This is more of a filter to get you into trending markets, but it still could be used to measure volatility. Second one of my favorites, if you subscribe to the channel, you know what I love, the ATR, which is the average true range. It's basically the range, very raw data that tells you the range this market is moving, highs minus lows. It does take into account gaps. So if you're looking at a daily time frame, it's going to take into account gaps as well, but it's just a good indicator in pips, in ticks, exactly, or dollars if you've got on stock, exactly how much that thing's moving. So visually you can see most people have it on a setting of 20, which gives you a 20 period, so 20 days, 20 hours, whatever your time frame is on. So you can adjust that to suit. Or 14 is another popular one as well. 20 to 14, both reasonably popular ones. It doesn't make that much difference. It's just obviously the longer the time frame, the more you're taking in. So the more it's going to be damped, and the shorter the time frame, the less data you've got, but the more relevant it's going to be to the current market conditions. So you need to adjust that to suit. Very useful on this, very useful to visually see, and you can draw your line on your chart and say, hey, when the ATR gets above this level, it means that I'm going to get in the market or get out of the market. So it's a very good way of gauging volatility in a very kind of a good manner, because it's literally price. It's just all it is price, highs, lows, the movement of price. So it's a very, very useful tool, that, especially on an intraday basis as well. You know, if you're on an intraday basis and you're trading a market that you think is pretty active, You know, you can look at the ATR and say, hey, great, I'm going to trade it while it's active. When the ATR starts to tail off, you might not want to trade because you're just going to give away stuff into choppy markets. It happens very, very often on an intraday basis. Lunchtime, very choppy. You can use the ATR to say, listen, when that slopes down, I'm out of it. When it starts to pick up again into the evening, I can get back involved. If it doesn't, I'll stay out until the next morning. So useful tool that. The final one I've got for you guys is Bollinger Bands. Now, Bollinger Bands, moving average with the standard deviations around that moving average. Most of the time they're set on a 20-period moving average and 2 standard deviations. Some people use 2.5, 3 is a little bit wide, 3 won't really get many touches, but price will move. If we draw this as a band, if I can try to do that here, price will move in and out of the band, but what will happen with the band is that the band will contract when price isn't moving much, and it'll expand when price is moving. So the width of the band is just one way of doing it. You can look at how price is relative to the band, but for this one, let's just look at pure volatility. The width of the band is going to tell us how volatile that market is. If it's a narrow band, it's narrowing right off, the volatility's died off, the standard deviation has gone lower. Not a lot's happening. When it's really expanding, it means the market shot up or down, up to the upside or downside, expanding those bands right out. And so you can use the width as a filter to get in or get out of the trade. Now, unlike ATR and ADX, Bollinger Bands will also give you the direction of volatility. So if the bands are sloping up and then they're expanding as well, or should I say if the moving average is sloping up and the bands are expanding, it's showing you its volatility to the upside, and if the moving average is sloping down and the bands are expanding, it's to the downside. But be warned, a little caveat to that, of course, is that you could get a spike way to the upside, causing moving average to slope up, and by the time that 20 period catches up, maybe price is coming down. So you've got to take that with a pinch of salt, but it's a little bit more directional than the average true range or the ADX. Anyway, guys, there's 3 indicators you could use to measure volatility. Like I say, why would you want to measure volatility? To maybe help filter the markets you want to be in or the markets you don't want to be in, that kind of stuff. Useful gauges to kind of manage your risk as well, and just generally useful knowledge to know that if you're heading into a new market, let's have a little look at my favorite volatility indicator tool and see what it's doing, and see if there's opportunity there to trade it. All right, guys, see you next one. Take care. Bye-bye.